Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree, Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. For the past few years, you might have noticed that there are several workers who quit their jobs. From that, we just saw a great resignation, where the number of people quitting jobs set a new high. The Great Reset claimed that in 2030, you might own nothing and still be happy, and with the Great Wealth Transfer, the millennials are expected to inherit $35 trillion. We can have the greatest wealth transfer in history. The Nasdaq has entered a bear market so far in 2022. There are hundreds of stocks that are trading at their all-time low, and the economy just started to fall because of inflation. Inflation is the highest in 40 years, and a recession is probably going to happen. Here's the thing that you might not know. After all the bad things you've heard on the news, there's still this good news. A lot of opportunities to gain faster than any time in your life. In this video, we'll dive into details that were proven by research, data, and what happened in history for us to see how crucial the future months will be. Let's talk about the market, because, well, let's just say it's not good. Those good old days in the market are gone, and now we have the total opposite, called the everything sell-off. Before we discuss the consequences for the stock market, home prices, and cryptocurrency, it's important to discuss the current status of the market, because the recent downturn may be divided into three groups. The first one is inflation, but it's not just ordinary inflation. Wages climbed in line with demand, forcing firms to quickly staff up to meet orders and production, and prices soared to a 40-year high. Yet where things went terribly wrong was in the definition of transitory. It's also worth noting that high inflation alone isn't enough to force everything to start selling off. However, it does result in the second category, which is the increase in interest rates, which included a 25 basis point rate hike in March, a 50 basis point rate hike in May, and many other 50 basis point rate hikes scheduled for the rest of the year. Greater interest rates, on the other hand, make stock market valuations less appealing. Mortgages cost more to borrow, firms must pay higher overhead, and the ordinary consumer has slightly less disposable money to spend, resulting in three uncertainties. There is currently concern that companies may begin to lay off employees, such as Robinhood, which laid off 9% of its workforce, and Rocket Mortgage, which was forced to shrink due to sluggish demand. I believe it's reasonable to expect this trend to continue in many other sectors. When you add in the uncertainty of an impending recession, the uncertainty of the Russia-Ukraine conflict, a pinch of rate hikes on the way, and stagflation, voila, you have the perfect recipe for a downturn. Let's begin with the stock market, which recently had its biggest decline since 2020. Even if you take a step back, it's a significant drop. The Nasdaq dropped more than 30%, the S&P 500 dropped 17%, and the Dow Jones dropped 13% from its peak, with the average retail portfolio being down 20%. At 4,000, the recession odds embedded in the S&P are close to zero. By their math, a 50-50 odds of recession equate to an S&P of 3,525, according to DataTrek. On the other hand, Morgan Stanley also agrees, predicting that the S&P may fall as low as 34.60 if profit growth slows due to recession fears. They also added that in the previous 10 instances when stocks endured deep losses in the first 4 months of a year, 6 saw the market extend its losses through December, and only 2 saw gains exceeding 10%, according to Strategea's data. Stock market losses, on the other hand, are minor in comparison to the second topic, cryptocurrency. According to CNBC, 40% of Bitcoin investors are now in the red, with prices down more than 55% from their peak. It's vital to note this since Bitcoin was frequently viewed as a hedge against inflation, a method to hold money, and a way to guard against market volatility over the last year. However, as we've seen this year, there is hardly any correlation, and it's actually following the same path as tech stocks. Alternatively, as interest rates rise, investors take a risk-off stance and move their money into less volatile, safer assets, causing cryptocurrencies to take the hit. Meanwhile, in terms of future holds, Fundstrat Global predicts a bottom of around 29,000 a coin, and El Salvador is still buying the dip. So it's clear that investors don't perceive real estate as a safe place asset just yet, especially since nothing is safe in this market. The immediate result is that rising rates have pushed 30-year mortgage rates to their highest level since 2009. But buyers are starting to see the positive side, as inventory is finally improving, which might mean more attractive prices. For the first time in what seems like an eternity, sellers are starting to lower their asking prices, and more than a few cities are seeing a fall, signaling that buyers may soon find affordability relief in the market. Apart from that, there have been endless Reddit postings about selling everything and moving to cash and wondering how bad things could be. Here are some things that you need to know, because if you will watch and listen carefully, you might witness one of the most significant wealth transfers in the last 2 years. And here it is. When you observe significant market drops, you need to look at them critically to understand what's really going to happen. And if we look at previous downturn markets, we can see that there are a lot of opportunities. When it comes to data like this, it's simple to go to the average and say that the average bear market lasts only about 1.4 years and has a 41% decline. There will always be outliers in history, and the market will hardly ever follow the norm every time. For example, in 2020, the market dropped 34% in a single month, the shortest bear market in history, before recovering to where we are today. Before that, during the Great Recession, the market declined 56% in 17 months, and if you've invested at the peak before the decline, it would have taken you approximately 4 years to make even. The same can be said about the dot-com crash, when technology stocks lost nearly 80% of their value, and many of them took more than 10 years to recover if they were lucky. There was also a 36% drop in 1960 and a 48% drop in the 1970s, and countless more throughout history, each with its own distinct reasons. However, conventional recessions are thought to cause a 26% decline in peak to trough earnings, indicating that we may have some more room to fall. Nevertheless, there is still some good news in that. It might be an excellent time to invest, because here is where the money is produced. If we exclude down of less than 20%, the average bull market has lasted 9.1 years with a combined return of 476%. And if we include declines of less than 20%, which are more like bumps in the road, the average bull market still lasts 4 years with a total return of 129%. However, that doesn't mean the next bull market will last 48 months. In fact, the shortest bull market since 1940 occurred shortly after the dot-com bubble, when markets soared 21.4% in 3.4 months before falling to 33.8% in the next 9 months. We also experienced a brief time during the Great Recession when the market soared 24% in 1.5 months before falling another 27% 2 months later. But aside from those two instances, we have to go back to the 1920s to find anything similar. There are numerous examples of bear markets lasting only a few days during the Great Depression. For example, a 23-day bull market with a 25% gain, followed by a 42% fall, then another month of the bull market with a 30% gain. Even while bull markets tend to continue substantially longer than bear markets, the context shows that severe volatility is fairly prevalent, and 20% declines or gains are not as severe as you would believe. I also want to share that half of the S&P 500 strongest days in the last 20 years were during a bear market, and another 34% occurred in the first 2 months of a bull market before. It was evident that a bull market had begun, because equities on the whole are forward-thinking, so basically the best time to purchase is usually before everyone else believes it's the best time to buy. Remember that. When it comes to this, the madness of never deviating from the plan has a method to it. The truth is that if you buy on a regular basis consistently, regardless of where the market is trading, with the purpose of keeping for at least 10 to 20 years, you will never lose money. If you could just do it automatically across a broad index fund, you'd be able to generate a lot more money much faster than almost any other method. Another thing is, when people are worried about their portfolios and resist the urge to sell everything, it's a good moment to buy in discounted, because unless you're a few years away from retirement, any market downturn should be viewed as a blessing. And besides, what if I told you that you could invest in 1929 just after the market crashed by 80%, or invest after the dot-com bubble burst when investors thought tech stocks were doomed, or buy real estate during the 2009 housing collapse when people thought the market would never recover? Each of those situations was a one-of-a-kind buying opportunity that would have rewarded investors that are patient and consistent. In each of these market crashes, it could be claimed that this time is different, and it most certainly is. There are no two bear markets alike, and once we don't have many unknowns, things will finally recover. None of us are sure when that will happen, but I believe we'll be able to look back on this point in time and recognize it was a fantastic buying opportunity. Well, this isn't to suggest that the market couldn't fall further, because it most surely can and will, but for anybody who has ever wished they could have invested more money 2 years ago, now is your time. Because as Warren Buffett puts it, the stock market is a device for transferring money from the impatient to the patient. This will be the greatest opportunity for one of the greatest wealth transfers in recent history for those who have the income and stay to the principles that have worked for the last 100 years. And that's for today's video. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.